Welcome back. Well, in light of starting out a new trading year, I thought it might be interesting to take a look back to determine what are the best and worst months to hold stocks. Now, we're going to take a look at 30 years of data starting in 1990 through the end of 2022. And what we see here, for example, are the monthly averages. This is the average return for the S&P 500 during each respective month. And we can see, for example, over the long term, 32 years or so, in January, the S&P 500 has a tendency to return around negative 0.1%, 10 basis points. February, it's just a little bit to the upside. However, the stronger months include March up 1%, April up 1.7%, May's up 0.9, July's up 1.4, 1.6 in October, 1.9 in November, and then on 1.3% in December. A little bit surprising because October tends to have the reputation of being a bad month, and it very well is during those very negative years, those stock market crash years. But overall, October actually tends to be, a strong month. Now, let's take a look at the top 10 years over the past 32 years. Which months represented the most amount of growth in the S&P 500? It's the same months that we've seen prior. March up 3%, April up 4%, July S&P 500 is up 3, October is up 3, December up 4%. Take a look at the worst 10 years, the 10 worst years over the past 32. Which months contributed to the majority of the sell-offs? Well, in January, S&P 500 was down 1%. February, it was down 2%. June, bad month, down 3%. August, down 2%. September, down 6%. And even December, down 2%. Now, notice that when we have strong years, like the best 10 years, the 10 best years over the past 32, January was up to 1% and December was up 4%. During the 10 worst years, we saw January was down around 1% and December was down around 2%. So January and December tend to be representative of those specific years, meaning when the market's strong, those months are strong. When the market's weak, those particular months are weak. But we really can't deny the fact that June, August, September tend to be the worst months, and that March, April, July, October, November, December tend to be the best months. In addition, the top 10 years, notice that August is the only month we actually see negative returns. In the bottom 10 years, it's really only May and October and November which we see any kind of substantial returns to the upside. November up 1%, October up 1% or so. Digging a little bit deeper into the data though, we can see here 1990 all the way down to 2022, and then divided by the months, January all the way through December, and the yearly returns all the way in the right-hand side. Notice, for example, during the strong years, 1991, the growth is spread out among many different months. In 1991, the S&P 500 was up 5% in January, 7% in February, 4% in May, 4% in July, 11% in December, contributing to an overall 26% return. In the year 1995, January up 2, February 4, March 3, April 3, May 4, so on and so forth. September's up another 4%, November up 4%. So we see in those strong years, we tend to see the growth is spread out among many different months. However, take a look at the weak years, like for example, 2008, S&P 500 down 44%. Most of that selling is contained to a few very bad months. June, 9% to the downside. September down 9%, October down 17%. Take a look at 2022. Well, it's actually a little bit spread out a little bit more evenly. We're down 20% for the month of year 2022. We see the worst months. April down 9%, June down 8%, and September down 9%. Other negative months to be sure. Take a look at, for example, 2002. The big selling occurred down June 7% to the downside, July 8%, and September 11%. So we tend to see, and this is really the takeaway, I think, is that in the strong years, the growth is spread out among many different months. In fact, it's spread out almost entirely over the course of the year. However, during weak years, during the worst years out there, the selling is really contained to a few very bad months. And that makes sense because stocks tend to go up a lot slower than they go down. Stocks tend to go up, under the anticipation of higher corporate earnings and, the emotion of greed, and we tend to buy stocks slowly. But when we think the stock market is going to go down, we sell stocks all at once, and the selling tends to occur very, very quickly. So if we take a look at the macroeconomic climate, corporate earnings, interest rates, and our gut level feeling, we say we think the stock market, for example, is going to go up, I would want to hold on to stocks for the long term. However, if I think the market's going to go down, I would want to get out of stocks very quickly because we don't know when that black swan event's going to occur, and that will lead to massive selling, such as 15% in August of 1998, 17% in October of 2008, and many other examples of that nature. Also, take a look at 2009, which actually was a strong year, but it started out down 11% in January and another 11% in February. So it really behooves us to examine the overall macroeconomic environment, make a decision whether we think stocks are going to go up or down. If we think they're going to go up, it's really in our best interest to create a diversified portfolio and hang on. If we think stocks are going to go down, it's better to sell sooner rather than later to avoid these very bad months. We hope this has been helpful. We look forward to seeing you back soon.